or wherever you are, and whatever time you're listening to this, good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets so that you can better understand how the markets operate, and also to help you identify the current trends in the market so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 204, and in this episode we are reviewing the performance of the financial markets during the 11th week of 2026, and that is from Monday the 16th to Friday the 20th of March. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the Federal Reserve on Wednesday voted to keep its key policy rate on hold as policymakers navigate their way through higher than expected inflation readings, plus mixed signs on the labor market, as well as the ongoing war in the Middle East. In a widely expected decision, the Federal Open Market Committee voted 11-1 to keep the benchmark federal funds rate anchored in a range of between 3.5% and 3.75%. This rate determines the overnight funding cost for commercial banks and also influences the cost for a broader range of consumer and business loans. The committee, in its post-meeting statement, made a few changes to its views on the U.S. economy, with a slightly faster pace of economic growth and higher inflation projections for 2026. In updates to their economic projections, Fed officials see the gross domestic product increasing at a pace of 2.4% in 2026, as officials also upped their inflation outlook for the year, as they now expect the personal consumption expenditures price index to reflect an inflation rate of 2.7%. Staying stateside, wholesale prices rose sharply in February, providing another sign that inflation continues to filter through the U.S. economy even before the impact of rising energy prices. According to the Bureau of Labor Statistics, the Producer Price Index, which is a measure of pipeline cost that producers pay for their input products, this increased by a seasonally adjusted 0.7% in February, and excluding volatile food and energy prices, the Core Producer Price Index increased by 0.5%. On a 12-month basis, headline producer price inflation came in at 3.4%, which was the highest rate since February 2025, whilst core inflation was recorded at 3.9%, and that is compared to the Fed's inflation target rate of 2%. Moving over to the Eurozone, the European Central Bank opted to keep interest rates on hold in March 2026, holding the deposit facility rate at 2% amidst increased uncertainty from the ongoing conflict in the Middle East. Policymakers said that the conflict had created upside risks for inflation and downside risks for economic growth, prompting traders to up bets on potential rate cuts by the European Central Bank later this year. The European Central Bank said that the ongoing conflict will have a material impact on near-term inflation through higher energy prices, while its medium-term implications would depend both on the intensity and duration of the conflict and on how energy prices affect consumer prices and the economy. The ongoing conflict in the Middle East has upset the economic equilibrium, threatening Europe's energy supplies, growth, and the outlook for consumer prices. The latest flash data from Eurostat showed that inflation in the Eurozone rose to 1.9% in February, up from 1.7% in January. The European Central Bank on Thursday revised its medium-term inflation expectations upwards, with headline inflation now expected to average at 2.6% in 2026. Over to the United Kingdom, where on Thursday the Bank of England's Monetary Policy Committee voted unanimously to keep its benchmark interest rate on hold at 3.75%. Before the war in Iran erupted in late February, the Bank of England had been expected to cut its key interest rate, known as the bank rate, during its March policy meeting. However, the ongoing conflict in the Middle East has sent global energy prices soaring, which will directly affect fuel and utility prices. The central bank said that its policymakers are alert to the increased risk of domestic inflationary pressures through second-round effects in wage and price setting, the risk of which will be greater the longer that higher energy prices persist. And in related news, the British government's borrowing cost surged to their highest level since the 2008 financial crisis on Friday, with the benchmark 10-year rate crossing above 5% as investors scrambled to price in rising inflation risks and a growing probability of interest rate hikes later this year. On Wall Street this past week, stocks tumbled in volatile trading on Friday as the U.S.-Israel conflict with Iran showed no signs of abating and oil prices continued their ascent. This move comes after Iran and Israel exchanged strikes overnight, with Israel launching new attacks against energy sites in the Persian Gulf. The Wall Street Journal reported, citing U.S. officials, that the Pentagon is sending thousands of additional Marines to the Middle East, and this was confirmed by CBS News, who said that heavy preparations were being made for sending ground troops to Iran, citing multiple sources. The Dow Jones Industrial Average shed 443 points, ending at 45,577, and the S&P 500 fell by 1.51% and closed at 6,506, whilst the tech-heavy Nasdaq Composite lost 2.01% before settling at 21,647. In the U.S. government bond market, Treasury yields jumped on Friday as investors began to fear that the Federal Reserve may not lower interest rates at all this year, as the war in the Middle East threatens to drive inflation even higher. The sell-off in bonds came after Iran and Israel exchanged strikes overnight, with Iran launching new attacks against energy sites in Kuwait and elsewhere in the Persian Gulf. With no end in sight to the escalation, investors are positioned for a more hawkish stance from the Fed as higher global oil prices reshape the global economic backdrop. The yield on the 2-year note, which is more sensitive to short-term Fed rate decisions, was up by nearly 6 basis points to trade at 3.89%. Meanwhile, the yield on the 10-year Treasury bond, which is a benchmark for U.S. government borrowing, added nearly 11 basis points to 4.39%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, the price of crude oil topped $112 on Friday after Iraq declared a force majeure at all oil fields operated by foreign companies and as drones struck two refineries in Kuwait. For your information, force majeure is a clause in contracts that allows a party to be excused from its obligations when an event beyond its control prevents performance. Iraq Oil Ministry sources told Reuters that Baghdad had declared the force majeure because it cannot ship crude through the Strait of Hormuz. As you're well aware, oil tanker traffic through the strait has plunged due to attacks by Iran. In the meantime, Saudi oil officials expect crude oil prices could climb above $180 a barrel if the disruptions from the ongoing war last through to the end of April 2026. In addition to that, U.S. Treasury Secretary Scott Bessent said Washington may soon lift sanctions on Iranian crude stored aboard tankers, which is estimated at about 140 million barrels of oil, a move that is aimed at easing price pressures following Iran's closure of the Strait of Hormuz. The international benchmark Brent crude rose by $3.54 to close at $112.19 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, gained by $2.18 to settle at $98.32 per barrel. In the precious metals market, the price of gold sank further on Friday, capping their worst week in 15 years as investors worried about the economic implications of the ongoing war in the Middle East. Friday's declines extended a tough session for precious metals on Thursday, with spot prices dropping around 3%. After suffering deeper losses earlier in the day amid rising fears about the economic fallout from the war in the Middle East. Gold is on track for its worst month since October 2008, but the metal is still up more than 5% in 2026, underscoring its massive bull run before the conflict in the Persian Gulf began. The price of gold plunged 9.6% this past week, which was its biggest weekly loss since September 2011, before eventually coming to a close at $4,574 per ounce. In the cryptocurrency market, the cryptocurrency market experienced a slowdown in the past 24 hours, with Bitcoin price showing little movement. And as of now, Bitcoin is trading within a narrow range, oscillating between $69,500 to $70,600. Bitcoin's price has been relatively stable at around $70,000 following a week of intense volatility. Earlier in the week, the price of Bitcoin surged past $76,000 but has since corrected by nearly 10%. This price drop is partly attributed to the ongoing geopolitical tensions, particularly the ongoing conflict in the Middle East. Rising oil prices and inflation fears have added to the uncertainty, leading to a broader market correction. The risk-on markets, including crypto, have experienced a downturn, and the future direction of Bitcoin's price may depend heavily on the resolution of these global issues. We now change scene to the Kenyan financial markets. And as usual, we start by looking at the domestic foreign exchange market, where the Kenya shilling dipped slightly versus the US dollar during the past week. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.52, and this is compared to a rate of 129.30 the previous week. Meanwhile, the sterling pound was priced at 172.49, and the euro was valued at 149.16. And on the regional front, one Kenyan shilling was changing hands for 29.09 Ugandan shillings and 20.11 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.26. The International Monetary Fund has previously raised concern about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $167 million for a grand total of $14.29 billion, which is equivalent to 6.1 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in forex reserves was attributed to the issuance of a dual tranche Eurobond for $2.25 billion, part of which was used to buy back existing Eurobonds that are approaching maturity. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained relatively stable at 8.68%, which is slightly below the revised central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, This averaged at around 8.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 19th of March, and the central bank received bids totaling to 35.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 147%. The central bank ended up accepting 29 billion shillings, and the results of the auction were as follows. The 91-day rate was flat at 7.56%, whilst the 182-day rate was also stable at 7.83%, and the 364-day rate declined by about 14 basis points for a weighted average rate of 8.34%. In the secondary bond market, the Central Bank of Kenya was offering investors the opportunity to switch their investments from a short-dated 5-year bond that matures in November 2026 and to invest in a longer-dated 15-year bond that matures in July 2034. During the Treasury bond switch auction, which was held on Monday, the 16th of March, the central bank received bids totaling to 22.2 billion shillings against an advertised amount of 15 billion shillings, representing a performance rate of 148%. For the destination bond, which is a 15-year bond that was initially issued in 2019 and now has 8.3 years left to maturity, the central bank ended up accepting 18.4 billion shillings at a weighted average rate of 11.58%, and this is compared to the bond's original coupon rate of 12.34%. Up next is our topical issue, and this week we're looking at the regulation of stablecoins in the Kenyan market. According to an article published in the Business Daily this past week, stablecoin issuers in Kenya will face stringent monthly reporting requirements as the country tightens regulation of digital currencies in order to ensure transparency and protection of investor assets. The proposed regulations by the Capital Markets Authority show that stablecoin issuers will be required to file monthly reports on transactions, the number of asset holders, the value of assets in circulation, and the composition of reserves backing the tokens. For your information, stablecoins are digital currencies that are pegged to currencies or assets such as the US dollar. In the recent past, stablecoins have been gaining traction in the Kenyan markets as they provide a faster and cheaper way to transfer money across national boundaries. Stablecoins are increasingly being used to facilitate international payments, with clients opting to bypass the traditional banking system, which is much slower and more expensive. However, on the downside, stablecoins have also been exploited for financial illegal activities such as money laundering and fraud. The proposed regulations are aimed at activating the Virtual Asset Service Providers Act that was signed into law in October 2025 and which introduced licensing requirements to protect crypto holders and combat money laundering. The new law places virtual asset providers under the joint regulation of the Central Bank of Kenya and the Capital Markets Authority. In addition to monthly disclosures, stablecoin issuers will be required to submit daily transaction data and appoint independent auditors to verify their reserve assets on a monthly basis. According to the World Crypto Rankings report published by global crypto exchange Bybit in 2025, Kenya was ranked as the 5th country worldwide in terms of volume of cryptocurrency transactions. Additionally, data from Chainalysis, which is a US-based blockchain analytics company, showed that in the 12 months to June 2024, Kenyans transacted about $3.3 billion worth of stablecoins. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the only way to achieve the impossible is to believe that it is possible. A quote by Lewis Carroll. Think about it. Thank you, and God bless.